What's up, guys? William Kelly here, back with another video at Kelly Knowledge Solutions, where we help you, the viewer, get smarter. So today what we're going to be talking about are the different investment options that we have, mainly in the stock market, dealing with savings accounts, dealing with certificate of deposits, also known as CDs, also known bonds, that's a big one, mutual funds, and single stocks. So we're going to start from the bottom for the rate of returns. In regards to the rate of return, so the lowest return on investment that you will receive is from a savings account. A savings account is the most widely known generic account to where you can save money, and that earns generally anywhere 0.002%, 0.02% in a savings account. Not much return at all. Really nothing going on there, just a place to essentially park money. The next one up that we will talk about is a CD, also known as certificate of deposit. So the name basically explains what it is. It is you receive a certificate when you deposit money. They give you a certificate of deposit. And so you go to the bank, you deposit money, and they give you a certificate. And generally that gets tied up for 1, 2, 3, maybe 5 years. And it is tied up. There is a penalty if you try to take that money out. Your money is basically locked up. There's not a lot of liquidity so that you can take the money and use it. It is tied up, and generally you're going to see anywhere from 2 to 3% on CDs. I don't personally invest in any CDs. I feel like it's a waste of money, and it's just I'm looking for a lot bigger return on my investment. So the next one that we'll talk about are bonds. You will see bonds in a lot of different areas, mutual funds and things like that. Bonds generally, the return on them are about 4 to 6%, and a little bit better than the CDs, but there are definitely better options. Bonds are not bad, but generally when people are a little older, they tend to shift towards the bonds just so that they are more secure and less risk averse. And so the next one, I personally, again, don't do any bonds because I am in it for the long haul. The longer that you stay in an investment, the less risky it actually becomes. So I mainly focus on mutual funds. This is my category. I am huge into mutual funds. I could talk mutual funds all day, and these generally can pull in anywhere from 6 to 14%. The average stock market, the average S&P 500 has pulled in almost 12% since the day it was born in, I believe, the late 1800s. So the late 1800s, the stock market has pulled in around 12%. I think it's like 11.9. So long-term wise, although the market goes up and down, it's a pretty good bet that a 10, 15 year investment plus is going to earn about 11, 12%, and that's mainly what I focus on and I look at. And it is a lot less. It's a lot less riskier than what this next category that we're going to talk about is single stocks. So single stocks is essentially how it sounds. It is owning a stock of a single company. So let's take Apple for example. If I took $1,000 and I put it in Apple, that would be me investing in a single stock. The risky part about that is if Apple does extremely well, we do extremely well. If Apple goes out of business tomorrow, we can lose absolutely everything. It's all based on one company and how they perform. There is a lot more reward if they do well, but there's also a lot more risk if they don't do so well. So basically pick, I guess, the most comfortable approach that you have in investing. And so for me, it's mutual funds. If you don't know what a mutual fund is, basically a mutual fund is, for example, if we had a room full of people and there was a jar in the middle of that room filled with people, there was this jar, and everybody took $1,000 of their own money and they put it into this jar. Now that is a mutually funded account. That jar is it's mutually funded by everybody in the room, and that basically becomes a mutual fund that now there's this big lump sum that they can go invest into bigger things, bigger companies, and things that you, the sole investor, just with your measly little $1,000 wouldn't necessarily be able to invest in and get a greater return. So another really good thing about mutual funds is it's actually diversified into multiple companies. So it's not like the single stocks. It is literally diversified 10, 15, 20, 30, 50, even 60 plus companies that mutual funds are funded. And so when you're looking at a mutual fund, if you go to any mutual fund company, you can actually pull up one and it'll show you these are the top 15 shareholders in this mutual fund. And it could be Microsoft, Apple, all of these big name companies that are in this mutual fund. It's not just based on one company such as Apple that if they don't do well, everything falls. If you are in a mutual fund of 60 different companies and 3 or 4 of them go out of business tomorrow, it doesn't matter. I mean, you might see it a little bit in your returns going down a little bit, but you still have 56 other companies that are hopefully doing well and fully operating. It's much less likely that 1 or 2 of those companies are going to drag that down because it's so diversified. It's incredible. So if that's all I got today. If you guys like what you saw, definitely drop a like, drop a comment, and if you guys are investing in some mutual funds, I would love to see kind of the mutual funds that you guys are in. I can definitely analyze them and see if I would personally maybe invest in them. But I definitely focus on more of the stock growth mutual funds, heavy stock growth mutual funds that are well diversified in a mutual fund. So if you guys like what you saw, subscribe, and we'll see you guys next time.